Imagine waking up one morning and realizing your bank is closed, not because of a holiday, not because of a technical issue, but because the money is gone. The doors are locked, the windows are dark, and the savings you trusted with your entire life have simply vanished. No warning, no explanation, just silence. This is not a fictional nightmare. This is exactly how the Great Depression truly began. Not with a stock market crash, not with panic on Wall Street, but with one deadly banking mistake that turned fear into collapse. It turned a recession into the worst economic disaster in modern history. Most people are told that the Great Depression started in 1929 when the stock market crashed, but that's only the spark. The real explosion happened quietly inside banks, far away from newspaper headlines. Because when markets fall, economies can recover. But when trust in banks dies, everything else follows. And the mistake that destroyed that trust is something very few people talk about today. Before we go deeper, if you like stories that expose the hidden mechanics behind economic collapses, make sure to like this video. Subscribe to the channel. Here on Silent Collapse, we break down how systems fail quietly before the world even notices. Subscribing now helps you stay ahead of the next collapse. It helps you understand what's coming instead of being confused by it later. Now, let's go back to America in the late 1920s. On the surface, everything looked perfect. The economy was booming. People were buying cars, radios, and homes. Banks were everywhere, and credit was easy. But beneath that optimism was a fragile system. It was built on one dangerous assumption: that banks could operate without strong protection, without safety nets, and without serious oversight. At that time, American banks followed a system that seems unbelievable today. There was no federal deposit insurance. If your bank failed, your money was simply gone. No refunds, no guarantees, no rescue. Banks were also allowed to take extreme risks with depositors' money. They invested heavily in speculative assets. They held very little cash in reserve. This system worked only as long as everyone believed it would. Then came the first shock. In 1929, the stock market crashed, investors panicked, and prices collapsed. And here's where the fatal mistake occurred. Instead of stepping in aggressively to stabilize the banking system, the Federal Reserve allowed banks to fail. It did not act as a backstop. Between 1930 and 1933, more than 9,000 American banks collapsed. Each failure destroyed savings, businesses, and livelihoods. Every closed bank removed money from the economy. It also removed confidence. And confidence is the true currency of any financial system. The biggest mistake was simple but catastrophic. The banking system was allowed to shrink when it needed to expand. This made everything worse. When banks fail, money supply contracts, loans disappear, businesses can't operate, workers lose jobs, spending collapses. This created a vicious cycle that fed on itself. Even worse, the Federal Reserve tightened credit instead of loosening it. Rather than injecting liquidity, it raised interest rates. This was done to protect the gold standard. This drained even more money from the economy. It happened at the worst possible moment. It was like treating a bleeding patient by draining more blood. The damage spread fast. As banks collapsed, ordinary Americans paid the price. Farmers couldn't get loans to buy seeds. Small businesses couldn't make payroll. Families lost their homes. Entire towns were economically erased. All of this happened not because money didn't exist. It happened because money was locked away. It was trapped behind failed institutions. Here's the terrifying part. The system didn't collapse loudly. It collapsed quietly, one bank at a time, one town at a time, one family at a time. That's why many people didn't realize how bad things were. By the time panic became visible, it was already too late. This is the pattern we talk about on Silent Collapse. People often ask why the government didn't stop it. The truth is, leaders believed failure was discipline. They thought weak banks deserved to disappear. They believed the market would correct itself. What they didn't understand was this: banks are not just businesses, they are the bloodstream of the economy. Let enough of them fail, and the entire body shuts down. By 1933, the situation was unbearable. Newly elected President Franklin D. Roosevelt took a drastic step. He declared a nationwide bank holiday. Every bank in the country was closed. For days, the entire financial system froze. Only banks that could prove stability were allowed to reopen. Soon after, deposit insurance was introduced. For the first time, people felt their money was safe. But by then, the damage was historic. Unemployment reached 25%. Millions were homeless. An entire generation grew up shaped by fear and scarcity. All of it traced back to one mistake: allowing the banking system to collapse, failing to protect it when protection mattered most. This is why the Great Depression lasted so long. Not because people stopped working, not because America ran out of resources, but because the system that moves money broke down, and no one fixed it in time. If this story feels uncomfortable, it should, because the same principle still applies today. Modern systems are more complex, but they are still built on trust. And when that trust cracks, collapse doesn't arrive with sirens. It arrives quietly, disguised as temporary problems and isolated failures. Take a second to think about this. How many times have officials said the system is strong, while ordinary people feel pressure rising? How often are institutions rescued, while individuals are told to wait? History doesn't repeat exactly, but it often rhymes. The Great Depression shows us that collapse isn't caused by one dramatic event. It's caused by small decisions. Decisions made under pressure, justified as temporary, ignored until they become irreversible. That's why understanding these stories matters. Not to create fear, but to recognize patterns. When people understand how collapse actually happens, they stop being surprised by it. If you've made it this far, you see why this channel exists. Silent collapse isn't about doom. It's about awareness. It's about seeing cracks early. Before the building falls. Before you go, I want to hear from you. Do you think modern banking systems have truly learned from the Great Depression? Or are we repeating the same mistakes? Drop your thoughts in the comments. Your perspective matters more than you think, and if this story helped you see the financial world more clearly. Share this video with someone else, because sometimes the most dangerous failures are the quiet ones. The story doesn't end with bank holidays and deposit insurance. In fact, what happened after the Great Depression quietly reshaped the modern financial world in ways most people never connect back to that single banking mistake. Because once trust is broken that deeply, systems don't just recover. They adapt, sometimes in dangerous ways. After 1933, the government did something radical. It promised people their money was safe. Deposit insurance calmed the panic almost overnight. People stopped rushing to banks. Confidence returned. But behind that calm surface, a new problem was being planted. When banks know deposits are protected, risk doesn't disappear. It shifts. Responsibility moves away from depositors and quietly concentrates inside institutions. Banks slowly learned that if they were important enough, they wouldn't be allowed to fail. This idea didn't exist before the Great Depression. It was born from that collapse. And decades later, it would return under a new name: too big to fail. The lesson policymakers thought they learned was simple: never allow mass bank failures again. But the lesson they didn't learn was equally important. Preventing collapse without controlling risk only delays the problem. It doesn't remove it. Over time, banking became safer for customers, but more aggressive behind the scenes. Leverage increased. Financial products became more complex. Risk was hidden, sliced, repackaged, and sold. On the surface, everything looked stable, just like the 1920s. And once again, trust replaced understanding. This is why the Great Depression still matters today. Not because the world will repeat 1933 exactly, but because the same human behaviors are still in control. Fear, greed, denial, and overconfidence never disappear. They just wear new clothes. Think about how collapses are described when they're happening. Contained. Temporary. Under control. Those words were used in the early 1930s too. Leaders didn't lie. They genuinely believed things would stabilize. That's what makes silent collapse so dangerous. It doesn't require evil intentions. It only requires delayed action. One of the most haunting parts of the Great Depression is how long it took people to realize the system itself was broken. Many blamed themselves. They thought they failed because they didn't work hard enough. In reality, the rules of the game had changed without warning. Money stopped flowing. Opportunity vanished. Effort alone was no longer enough. This psychological damage lasted for decades. People saved excessively. They avoided banks. They distrusted markets. Entire families passed down financial fear as survival wisdom, all because a system built on trust forgot to protect it when it mattered most. And this brings us to the most uncomfortable truth. The banking mistake that triggered the Great Depression wasn't technical. It wasn't complicated. It was moral and structural. Leaders chose to protect a theory instead of people. They protected gold reserves, balance sheets, and ideology, while the public absorbed the pain. That choice turned a downturn into a disaster. Here on Silent Collapse, we talk a lot about warning signs. And the biggest warning sign isn't falling markets or bad headlines. It's when institutions prioritize stability on paper over stability in real life. When numbers look fine, but people feel desperate. That gap is where collapse begins. If history has taught us anything, it's that systems don't fail when they are weak. They fail when they are rigid, when leaders refuse to adapt quickly enough, when they underestimate how fast trust can evaporate. Today's world feels different. Faster, digital, more advanced, but the foundation is the same. Banks still rely on confidence. Money still relies on belief. And belief can vanish overnight. That's why understanding the Great Depression isn't about the past. It's about recognizing patterns that quietly reappear. Because the next collapse, like the last one, won't announce itself clearly. It will arrive disguised as manageable risk. Before we end, take a moment and think about this question. If the Great Depression began not with a crash, but with a failure to protect trust, what does that say about the systems we depend on today? Write your answer in the comments. Reading different perspectives helps everyone see the bigger picture. And if you believe more people need to understand how collapses actually begin, share this video. Awareness spreads faster than panic, but only if people choose to pass it on. This is Silent Collapse.